In 1637, a single tulip bulb in Amsterdam sold for more than 10 times the annual income of a skilled craftsman. Within months, the entire market collapsed and fortunes vanished overnight. You've probably heard of tulip mania. It's become the go-to cautionary tale about speculative bubbles. But here's what's interesting. While everyone knows about the tulips, there are 5 other economic catastrophes throughout history that were far more devastating, affected millions more people, and contain patterns we're seeing right now in modern markets. Yet most people have never heard of them. If you want to understand what these forgotten crises reveal about today's economy, you're in the right place. Let's dive in. History has a strange way of remembering certain events while letting others fade into obscurity. We all know about the Great Depression, the 2008 financial crisis, even the Dutch tulip craze. But the economic disasters I'm about to share with you, they have been largely forgotten by mainstream education and media, despite being some of the most instructive examples of what happens when currency systems, speculation, and government intervention collide. And that's a problem, because the patterns from these events are showing up again in ways that could affect your savings, your purchasing power, and your financial future. Today, we're going to explore 5 economic crises that history forgot. Each one reveals something critical about how economies collapse, how currencies fail, and what warning signs to watch for. By the end of this video, you'll understand patterns that most people miss, patterns that are unfolding right now. Let's start with a crisis that makes the 1929 crash look manageable by comparison. The Panic of 1873 kicked off what historians call the Long Depression, and it wasn't just long. It lasted 65 months in the United States and even longer in Europe. This wasn't a recession. This was an economic catastrophe that reshaped the entire global financial system. Yet most people today have never heard of it. Here's what happened. In the 1860s and early 1870s, railroads were the hot investment. Think of them as the tech stocks of their era. Everyone wanted in. Banks were throwing money at railroad companies. Investors were buying railroad bonds like crazy, and the construction boom seemed unstoppable. According to economic historians, more than 33,000 miles of railroad track were laid in the United States between 1868 and 1873 alone. The speculation was off the charts. Then, in September 1873, J. Cook & Company, one of the most respected banking houses in America, suddenly collapsed. They'd overextended themselves financing railroad construction, particularly the Northern Pacific Railway. When they couldn't meet their obligations, panic spread instantly. Within days, the New York Stock Exchange closed for 10 days, the first time in its history. Banks failed by the hundreds. The unemployment rate in New York City hit 25%. Soup kitchens appeared on street corners. Quick note, this video is for educational purposes only and does not constitute financial advice. Always do your own research and consult with qualified professionals. But here's the crazy part. This wasn't just an American problem. The crisis spread globally because, for the first time in history, international financial markets were deeply interconnected through railroad bonds and currency flows. The Vienna Stock Exchange crashed in May 1873, months before the American collapse. Germany entered a recession. Britain's economy contracted. This was the world's first truly global financial crisis. And it happened because of over-leveraged speculation in a hot sector, backed by easy credit. Sound familiar? It should. We saw the same pattern in 2008 with mortgage-backed securities. We're seeing it now with certain tech sector valuations. The Panic of 1873 teaches us that when everyone's piling into the same investment, when credit is flowing freely, and when sophisticated financial instruments are being created faster than people can understand them, that is when you need to pay attention. Now, let me show you exactly what I mean with our second forgotten crisis. In 1720, France experienced what might be the most spectacular currency collapse in European history, the Mississippi Bubble, and the person responsible was a Scottish economist named John Law, who convinced the French government to try something revolutionary, replacing gold and silver coins with paper money backed by the theoretical wealth of French territories in Louisiana. Law's idea was brilliant on paper. France was drowning in debt from wars under Louis XIV. Law proposed creating a central bank, issuing paper currency, and backing it with shares in the Mississippi Company, which supposedly had exclusive rights to trade in the vast Louisiana territory. The company would generate enormous profits from trade, gold, silver, and development. Investors would get rich, and France would solve its debt problem. The French government bought in. Law was given unprecedented control over France's finances, and initially it worked. The stock price of the Mississippi Company soared. According to financial records, shares that started at 500 livres reached 10,000 livres by late 1719. Parisians from all classes were buying shares. The French even created a new word, millionaire, to describe the newly wealthy investors. But there was a fundamental problem. The wealth was theoretical. The Louisiana Territory wasn't producing anywhere near the gold and riches Law had promised. The company's value was built entirely on speculation and the printing press. Law kept printing more money to keep the scheme going, which created inflation. Prices in Paris doubled, then tripled. You might be thinking, how does this end? Exactly how you'd expect. In 1720, investors started demanding to convert their paper money and shares back into gold and silver. The bank couldn't deliver. The whole system imploded. Share prices collapsed 97% from their peak. Thousands of investors were wiped out. France's currency was destroyed, and the country wouldn't try paper money again for 90 years. Here's what most people miss about the Mississippi bubble. It demonstrates that you can't create real wealth by simply printing currency and linking it to speculative assets. The underlying value has to be real. When central banks today engage in quantitative easing, essentially printing money to buy assets, the same fundamental question applies. What's backing this currency? What's the real productive capacity? These are questions worth asking. Now, this is where it gets really interesting, because our third crisis shows what happens when a currency is not just mismanaged. It's deliberately devalued by the government itself. The Roman Empire's currency collapse doesn't get taught in economics classes, but it should. For centuries, Roman currency was remarkably stable. The silver denarius maintained its value because it contained actual silver, about 95% pure silver under Emperor Augustus. People trusted it across the entire Mediterranean world. But starting in the 3rd century AD, Roman emperors faced a problem that sounds eerily modern. They had massive military expenses, bureaucratic costs, and public programs to fund, but they didn't have enough tax revenue. Their solution? Debase the currency. They started reducing the silver content in the denarius while keeping the face value the same. Under Emperor Nero, the denarius dropped to about 90% silver. By the time of Emperor Septimius Severus, around 200 AD, it was down to 50%. According to historical records, analyzed by economic historians, by 265 AD, the denarius contained less than 5% silver. It was basically a bronze coin with a thin silver coating. The Roman government was effectively counterfeiting its own money. The results were catastrophic. Merchants stopped accepting denarii at face value. Prices skyrocketed, what historians call the Crises, crisis of the 3rd century, saw price inflation estimated at 1,000% or more over several decades. Trade broke down. People reverted to bartering. The economy that had supported history's greatest empire was falling apart. Here's the pattern to understand. When governments face the choice between raising taxes, cutting spending, or devaluing currency, they often choose devaluation because it's the politically easiest option in the short term. Citizens don't immediately feel the pain like they would with tax increases, but the long-term damage is severe. It destroys savings, disrupts commerce, and breaks the fundamental trust that makes an economy function. And here's where it gets concerning. According to the Bank for International Settlements, global debt levels hit record highs in recent years, with government debt in advanced economies exceeding 120% of GDP. That's peacetime debt at wartime levels. History shows us what often happens next. But wait, there's something even more important about our 4th crisis, because it reveals how quickly confidence can evaporate. The Argentine peso crisis of 1989-1990 is living memory for millions of Argentines, yet it's barely mentioned in Western financial education. And that's a mistake, because it demonstrates how hyperinflation can devastate a modern, relatively developed economy. Not just Weimar Germany or Zimbabwe, but a country with universities, industries, and a functioning government. In the 1980s, Argentina's government was running massive deficits, partially due to debt accumulated during the military dictatorship years. Unable to borrow more from international markets and unwilling to implement severe austerity, they turned to the printing press. The central bank began monetizing government debt, literally printing pesos to pay bills. At first, inflation was high but manageable, maybe 100% or 200% annually. People adapted, but then it accelerated. According to World Bank data, by 1989, Argentina's inflation hit 3,079% for the year. Think about that number. Prices weren't just rising, they were tripling every year. A coffee that cost 100 pesos in January might cost 300 pesos by December. People's behavior changed completely. Workers demanded to be paid daily instead of monthly because money lost value so quickly. Grocery stores changed prices multiple times per day. Citizens would rush to spend their paychecks immediately on goods or foreign currency, because holding pesos overnight meant losing purchasing power. The entire economy became focused on escaping the national currency. The social impact was severe. The middle class saw their savings evaporate. Pensions became worthless. According to economic studies of the period, poverty rates in Argentina jumped from around 25% to over 47% within 2 years. This wasn't ancient history. This was the 1980s and 90s in a country with modern infrastructure and education. Here's what the Argentine crisis teaches us. Hyperinflation isn't just an economic problem, it's a social one. It destroys the basic contracts that hold society together. The promise that if you save money today, it'll have value tomorrow. That if you earn a salary, you can plan for next month. When those promises break, everything destabilizes. And here's that third sign I mentioned at the beginning, the one that's most concerning. Our fifth forgotten crisis is the Asian financial crisis of 1997-98. And while it's not completely forgotten, its lessons are often misunderstood. This crisis revealed something critical about modern financial systems, how quickly contagion can spread and how interconnected vulnerabilities can cascade across entire regions. The crisis started in Thailand in July 1997. For years, Thailand had pegged its currency, the baht, to the US dollar at a fixed rate. This seemed stable, but it created hidden vulnerabilities. Thai businesses borrowed heavily in dollars because dollar interest rates were lower than baht rates. Real estate developers, banks, and corporations accumulated massive dollar-denominated debt. When Thailand's economy started showing weakness and foreign investors began pulling money out, the government faced a choice: defend the currency peg by spending their foreign reserves, or let the baht float freely. They tried to defend it, but according to IMF reports, they burned through billions in reserves in just weeks. In July 1997, they gave up. The baht was allowed to float, and it immediately plummeted, losing about 50% of its value against the dollar within months. Now here's the cascade effect. Thai companies that had borrowed in dollars suddenly found their debts had doubled in baht terms. Bankruptcies spread. Banks collapsed. But the crisis didn't stop at Thailand's borders. Investors looked at other Asian countries with similar structures, Indonesia, South Korea, Malaysia, the Philippines, and started pulling money out there too. Within months, Indonesia's rupiah lost 80% of its value. South Korea's won collapsed. According to World Bank estimates, the regional economic contraction wiped out years of economic gains. Unemployment soared. The IMF had to organize bailout packages totaling over $110 billion. What made this crisis particularly devastating was the speed. In our interconnected financial world, money can flow out of a country in hours, not weeks. Currencies that seemed stable can collapse in days once confidence breaks. And the triggers aren't always obvious. Thailand's problems seemed manageable until they suddenly weren't. The Asian financial crisis teaches us about systemic risk. It's not enough to look at one country or one indicator. You have to understand the connections, the currency pegs, the debt structures, the flow of international capital. Because in modern markets, problems in one place can trigger crises everywhere. So what do these 5 forgotten crises tell us about today? First, speculation fueled by easy credit always ends badly. Whether it's railroad bonds in 1873, Mississippi Company shares in 1720, or modern asset bubbles, the pattern is the same. When everyone's borrowing to invest in the hot sector, when valuations disconnect from underlying fundamentals, history suggests caution. Second, currency debasement has consequences. Rome's emperors learned it. France learned it with John Law's scheme. Argentina learned it in 1989. You can't create real wealth by diluting currency. Eventually, people lose confidence, and when confidence goes, everything goes. Third, fixed systems are vulnerable to sudden breaks. Thailand's dollar peg seemed stable until it wasn't. When pressure builds in a system that's artificially constrained, the eventual release can be violent. Fourth, contagion spreads faster than ever. The 1873 crisis took weeks to spread globally by telegraph. The 1997 crisis spread in days via electronic markets. Today, with high-frequency trading and global capital flows, contagion can spread in minutes. Fifth, and perhaps most important, no one can predict exactly when or if these patterns will culminate in crisis. But history shows that certain warning signs tend to appear. Asset valuations disconnected from fundamentals, high levels of debt relative to GDP, currency policies that prioritize short-term political goals over long-term stability, and increasing financial complexity that obscures risk. Here's how to think about this. These historical crises aren't roadmaps, they're frameworks. They help us recognize patterns and ask better questions. When you see speculation heating up, you can ask, what's the real underlying value? When you hear about currency policy changes, you can ask, what's backing this? What are the long-term implications? When you see interconnected financial systems, you can ask, where are the vulnerability points? The goal isn't to predict the future or make you afraid. It's to be informed and aware. Understanding these patterns doesn't tell you exactly what will happen, but it helps you recognize when conditions are becoming similar to past crises. And that awareness is valuable. These 5 crises were forgotten, but their lessons shouldn't be. The Panic of 1873 showed us global financial contagion. The Mississippi Bubble revealed the dangers of creating wealth from paper and speculation. Rome's currency collapse demonstrated what happens when governments debase money. Argentina's hyperinflation proved that modern countries aren't immune to currency catastrophe. And the Asian financial crisis taught us how quickly confidence can evaporate in interconnected markets. Each crisis has something to teach us about the world we're living in right now. If this changed how you think about economic history and current financial risks, you'll want to check out our video on currency debasement patterns throughout history. It goes even deeper into what we're seeing today, and if you haven't subscribed yet, now's the time. We uncover these hidden patterns every week, giving you the financial literacy that mainstream education often misses. See you in the next one.